Yesterday, a corporate filing quietly finalized a transaction that effectively rewrites the geographic reality of North American telecommunications infrastructure. BCE, the parent company of Bell Canada, completed the acquisition of Ziply Fiber, a regional American internet provider operating across Washington, Oregon, Idaho, and Montana. This was not a tentative partnership or a pilot program. It was an aggressive $5 billion cash transaction coupled with the assumption of $2.6 billion in outstanding net debt, handing Canada's single largest telecommunications provider 1.4 million fiber internet locations across 4 U.S. states. To understand why this shift marks a major departure from corporate norms, one must look at the sequence of events leading up to the August 1, 2025 closing date. Historically, Canada's highly protected telecom sector allowed major domestic players to rely on steady internal subscriber growth without risking significant capital south of the border. However, in November 2024, BCE pivoted entirely by entering into a definitive agreement to purchase Ziply, a network built out of the bankrupt remnants of Frontier Communications. Exactly 1 month before the deal closed, on July 1, 2025, Bell finalized the sale of its 37.5% ownership stake in Maple Leaf Sports and Entertainment to Rogers Communications for $4.7 billion. That sequence is not coincidental. It represents a deliberate financial calculation to liquidate passive domestic sports assets and immediately convert them into an active, high-stakes wager on American physical infrastructure. That strategy becomes clear when evaluating the specific operational footprint Bell purchased in the Pacific Northwest. Ziply Fiber inherited a neglected legacy copper network tracing back to 1964, but between 2020 and 2024, private investors injected over $500 million into upgrading more than 150 communities to high-speed fiber. By valuing the entity at 14.3 times its projected 2025 EBITDA, Bell paid a steep premium to instantly acquire 442,225 active internet subscribers in a single day. Yet, the true scale of the ambition surfaced in May 2025, when BCE partnered with the Public Sector Pension Investment Board to establish Network Fiber Co., a joint venture backed by $1.5 billion in capital, aimed at deploying up to 8 million additional fiber locations across the United States. What that framework does, structurally, is redirect the gravity of Canada's flagship telecom provider away from its domestic base, creating a projected transnational footprint exceeding 16 million total North American locations. But here is the other half of the strategy, and this is the part that management would rather the public not dwell on. While pouring billions into American fiber, BCE has spent the last 2 years systematically downsizing its operations at home. The contraction began in June 2023 with the elimination of 1,300 positions, followed by a massive reduction of 4,800 jobs and the sale of 45 regional radio stations in February 2024. The shedding of domestic labor continued through 2025, with 1,200 unionized buyouts in February, another 690 management cuts in November, and an additional 700 jobs eliminated as recently as June 2026. This stark contrast in capital allocation reveals a deliberate choice to trim Canadian operating expenses to fuel American infrastructure expansion. The financial pressure driving this reallocation of capital is directly visible on the company's balance sheet, particularly regarding its long-term liabilities and shareholder obligations. For over 15 years, BCE functioned as a core income asset for Canadian portfolios, steadily climbing to an annual payout of $3.99 per share by early 2025, even as its long-term debt surpassed the $30 billion mark. The breaking point arrived in May 2025, when management implemented a drastic 56% reduction in the annual dividend, dropping it to $1.75 per share to conserve cash. As independent analysis from Veritas Investment Research later noted, management failed to maintain financial flexibility, committing to some multi-billion-dollar foreign acquisition while operating with highly leveraged debt structures. That fiscal reality confirmed that the expansion into the United States is less an aggressive luxury and more of a defensive maneuver designed to outrun stagnating domestic balance sheets. Now zoom out and look at the highly competitive ecosystem Bell has just entered, which is vastly different from the cozy regional dynamics of the Canadian market. The U.S. broadband landscape in 2026 is a consolidated battleground where the three largest wireless giants are aggressively absorbing independent networks. Verizon absorbed Frontier Communications in early 2026 to target a goal of 50 million fiber passings. AT&T finalized its purchase of Lumen Technologies' mass-market assets to expand by 5 million locations annually, and T-Mobile acquired Lumos alongside several regional providers. Crucially, these American incumbents possess an enterprise advantage that Bell completely lacks south of the border: the ability to seamlessly bundle home fiber with nationwide mobile wireless plans. What this means structurally is that Ziply, operating at a 25% customer penetration rate compared to AT&T's 40% in established markets, faces a punishing math where foreign-owned fixed-line assets must compete against fully converged, multi-platform domestic networks. This shift toward foreign expansion is ultimately a direct response to a deteriorating domestic environment within Canada. Throughout 2025 and 2026, regulatory changes by the CRTC forced major Canadian carriers to open their proprietary fiber networks to wholesale competitors at heavily reduced rates, severely compressing profit margins. Simultaneously, federal policy adjustments that reduced immigration levels slowed the pace of new subscriber acquisition across the country, while an ongoing wireless price hoist war initiated by Freedom Mobile further diluted average revenue per user. Facing a domestic market that is structurally contracting and unable to generate the high-yield growth required to service its massive debt, BCE management viewed the underpenetrated suburban and rural corridors of the American Pacific Northwest as an indispensable financial escape route. The initial financial results for the first quarter of 2026 show a modest 4% uptick in total revenue and a 2.9% rise in adjusted EBITDA, buoyed by a 9.7% growth spike in its AI-powered business services division. These metrics indicate that the immediate corporate restructuring is yielding cost efficiencies, but they do not erase the underlying long-term vulnerabilities. By choosing to lay off thousands of Canadian workers while simultaneously funding the construction of high-speed broadband corridors for American households, a 145-year-old Canadian institution has signaled that its corporate survival depends on an entirely different geography. But the more consequential question, the one that infrastructure analysts and telecom regulators on both sides of the border are watching with intense strategic scrutiny, was still unanswered. The unresolved tension surrounding BCE's strategic exit from domestic dominance to assume billions in American debt highlights a stark structural divergence. On one side of the border, thousands of experienced network technicians are being laid off to suppress domestic capital intensity. On the other, billions in cash are flowing into physical conduits underneath 4 U.S. states. This calculated geographical arbitrage represents a fundamental shift in how North American telecom giants must chase growth when their home markets saturate. To fully grasp this transition, one must examine the specific mechanics of the joint ventures and regulatory maneuvers that corporate management finalized throughout late 2025 and early 2026. The baseline architecture of this American push centers directly on the specific legal and financial framework of Network Fiber Co., the joint venture established in May 2025. According to official corporate disclosures, the Public Sector Pension Investment Board holds a strict 51% controlling interest in the vehicle, while BCE controls the remaining 49% through its newly acquired Ziply Fiber operating subsidiary. PSP Investments committed an initial tranche exceeding $1.5 billion in cash directly to this venture. That specific structural breakdown tells you that Bell could not legally or financially execute an expansion of this magnitude on its own balance sheet. By surrendering the majority equity stake to a massive public pension fund, corporate management successfully shielded BCE from carrying the immediate consolidated capital expenditure of building millions of raw, unbuilt U.S. fiber lines, shifting the initial execution risk to institutional pension capital. This deliberate risk-sharing mechanism allowed management to preserve its remaining capital to target premium asset acquisitions rather than funding slow, organic greenfield construction from scratch. At the October 14, 2025 BCE Investor Day in Toronto, executive leadership confirmed that Ziply Fiber would target a highly compressed expansion trajectory, aiming to scale its existing footprint to more than 3 million total passings by the end of 2028. To support this ramp-up, the combined entities plan to leverage specific federal funding allocations, focusing heavily on upcoming state disbursements from the $42.45 billion U.S. Broadband Equity, Access, and Deployment Program. That detail tells you that Bell's geographical focus on the Pacific Northwest is highly calculated. By avoiding the deeply saturated urban corridors of the American East Coast, the company positioned its new assets precisely where state-level federal subsidies are explicitly designated to offset the massive logistical costs of suburban and rural infrastructure deployment. www.bnbloomberg.ca The strategic rationale underpinning this capital migration was framed clearly by corporate leadership as an absolute operational necessity. During a high-level briefing accompanying the release of the company's full-year 2025 financial metrics, BCE President and Chief Executive Officer Mirko Bibic stated that the acquisition of Ziply Fiber marks a key milestone by establishing a significant foothold in the attractive U.S. market, creating a powerful platform for long-term growth, scale, and geographic diversification. What that response reveals is a deliberate choice to deprioritize the historical, highly protected Canadian domestic market in favor of an open corporate frontier. It serves as an explicit acknowledgement that the regulatory and macroeconomic landscape inside Canada no longer offers the premium returns required to satisfy institutional shareholders or sustain legacy corporate operations. ZiplyFiber.com That institutional pivot becomes even more logical when evaluating the harsh financial contractions surfacing across the broader Canadian telecom landscape throughout the first half of 2026. Official industry reports from the first quarter of 2026 show that the combined impact of the CRTC's mandatory wholesale fiber access rates and aggressive handset discounting from Quebecor's Freedom Mobile compressed industry-wide average revenue per user by over 3.5% year-over-year. This margin compression occurred at the exact moment that federal adjustments to immigration targets began materially slowing the pace of organic new subscriber additions across major metropolitan centers. That sequence is not coincidental. It represents a structural ceiling. The domestic market has evolved into a zero-sum cannibalization campaign where legacy providers must spend heavily on retention just to defend flat lines on a ledger. A reality that structurally validates Bell's decision to move its capital into unhedged American geography. However, the competitive arena Bell entered across Washington, Oregon, Idaho, and Montana presents an entirely separate layer of operational friction. In early 2026, Verizon finalized its comprehensive acquisition of Frontier Communications, while AT&T expanded its established open access fiber partnerships, maintaining a dominant 40% subscriber penetration rate across its existing fiber footprint. By comparison, Ziply Fiber's subscriber penetration at the time of the BCE closing sat at approximately 25%. That gap represents a severe competitive vulnerability, because American giants can easily bundle high-speed home fiber with nationwide 5G mobile wireless plans on a single, discounted monthly invoice. A foreign-owned, fiber-only operator like Ziply must work twice as hard to capture and retain the exact same suburban consumer base to bypass this lack of a domestic mobile wireless network. Corporate management has quietly initiated an enterprise-level pivot that extends far beyond residential internet lines. Financial statements from BCE's first quarter 2026 results reveal that while traditional product revenues declined by 15%, the company's business markets division achieved an advanced 9.7% revenue growth spike, driven entirely by AI-powered enterprise data solutions and cloud security architectures under its Bell Cyber and Attico divisions. What that shift does structurally is transform the underlying utility of the physical fiber lines Bell is burying across the Pacific Northwest. Instead of merely selling consumer broadband to individual households, The long-term play is to utilize Ziply's expanding footprint to transport massive, high-margin data payloads for American enterprise clients, cloud data centers, and regional logistics hubs. Yet, this entire multi-billion-dollar strategic transition remains acutely tethered to a highly volatile regulatory climate that corporate executives cannot fully control. As the United States enters the latter half of 2026, bilateral discussions regarding cross-border data security, critical infrastructure protection, and strict reciprocal trade agreements are intensifying in Washington because broadband networks are increasingly classified as highly sensitive national security assets. The presence of a foreign telecom corporation controlling vital communication lines near major military installations in Washington and Idaho is drawing renewed legislative scrutiny. The critical pivot point, the single upcoming event that infrastructure analysts and telecom lawyers are watching with intense strategic focus, is the scheduled late 2026 compliance review by the Federal Communications Commission regarding foreign ownership thresholds for interstate telecommunications infrastructure. Synthesizing these multi-layered operational data points, structural corporate realignments, and shifting competitive dynamics reveals a cohesive long-term pattern. What began as a localized infrastructure transaction in the American Pacific Northwest is emerging as a comprehensive strategic blueprint for how a legacy utility model attempts to reinvent itself across an entire continent. By evaluating the collective responses of the principal corporate and national actors, the ultimate trajectory of this capital migration becomes clear. For Canada, the departure of BCE's capital is a highly consequential structural indicator. The combination of restrictive regulatory intervention, reduced immigration targets, and domestic margin compression has effectively capped the growth potential of the nation's critical infrastructure. This domestic contraction means that Canadian telecom networks will likely face a period of capital starvation as their flagship operators channel available cash flow away from local upgrades to defend foreign expansions. The immediate corporate strategy within Canada will center on intensifying automation, driving further labor efficiencies, and liquidating non-core assets to manage the existing $35 billion long-term debt load for the United States. The entry of Canadian-backed entities introduces a well-capitalized challenger into an underserved regional market just as federal funding begins to flow. The strategic footprint of Ziply Fiber and Network Fiber Co. establishes a vital neutral host network across critical northern corridors. This expansion directly addresses rural connectivity deficits without requiring domestic wireless carriers to overextend their own balance sheets on low-density geography. The next logical move for American industry giants like Verizon and AT&T is to watch the subscriber penetration metrics of these localized networks, treating them as turnkey acquisition targets. Once the capital-intensive deployment phase concludes, the overarching pattern underlying these individual movements demonstrates that when a protected domestic monopoly faces structural stagnation, geography becomes secondary to asset transformation. Bell Canada liquidated a secure, passive position in its home market to buy an active, unhedged foothold in a foreign infrastructure boom. This transaction reveals that the long-term viability of modern telecommunications providers is no longer determined by the size of their domestic footprint, but by their agility in migrating capital to where data demands are fastest and least regulated. Ultimately, the survival of a century-old institution is being wagered on the premise that it is safer to compete as an aggressive outsider in a hyper-competitive foreign market than to remain a slow-growing incumbent in a contracting home arena. That shift confirms that the traditional, localized boundaries of national utilities are dissolving into globalized infrastructure plays, where physical lines are merely conduits for high-margin enterprise data. The real test is no longer whether a corporate balance sheet can support legacy employment or historic dividend yields, but whether it can sustain the immense capital velocity required to build out the next continental data network. A 145-year-old Canadian institution has officially crossed the border to chase that scale, leaving behind the territory that built it to gamble on someone else's future. The physical lines are locked into place, The capital has braided, and the Continental Board,